Markets woke up from their long holiday slumber with a pretty rousing rally here today. The markets being up about 2.5% depending upon the index. In fact, about 88% of the stocks in the S&P 500 closed in the green today, so it was a broad-based rally with just a handful of names sitting out. We're going to talk about that. We're going to talk about some of the crazy action in the cryptocurrency universe over the weekend. We'll also talk about some of the recent outperformance with gold and emerging markets. And then we're going to get into our trade application example where I wanted to feature a tech stock for a bullish swing trade to the upside that not only has a bullish near-term divergence signal, but it's one of the few tech stocks that's actually trading above its rising 30-day moving average right now. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 21st, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel. Then be sure to go down below into this description area. Make sure you're signed up for our email distribution list. That way you can be notified whenever we post these videos. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ, and I would encourage you to follow me if you're not doing so already. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, it was a nice way to start off a holiday shortened week here. Of course, yesterday, the observance of Juneteenth, and so we only have 4 days of trading this week, starting here on Tuesday. But as you can see, there was a little bit of pent-up demand for shares over the weekend. And for those of you that were watching the financial markets in general over the weekend, you might have noticed that there was quite the chaotic trading taking place within cryptocurrencies, with Ethereum and Bitcoin and Dogecoin and all those kind of crazy cryptos going up and down and all over the place. And it made you wonder how we were going to, enter into this week from the stock market's perspective. And the good news is it didn't really shake it to its core. So as you can see, there was lots and lots of green names to choose from. Some of the brighter ones to point out would be up here in the upper right. We've got Tesla up 9% today. So of course, a massively important company within the consumer discretionary sector ETF. We also had NVIDIA do pretty well here today, up about 4% within the tech space. We also had United Healthcare up about 6% in the healthcare space. We had BlackRock within the financials space up about 5% here today. We had Alphabet up about 4% in the communication space. We had some nice winners in the consumer staples. Walmart was up over 3%. And in the industrials, we had Raytheon up over 4%. And then you had a really nice batch of bright green colors here in the energy area, led by ExxonMobil. That giant coming roaring back here in recent weeks and months. It was up 6% here today. Conoco was also up 6%. So, there was a lot to kind of choose from there. Lots and lots of different types of companies that were up nicely here today. Volumes today were a little bit lighter than you'd probably prefer for a really robust snapback day like this. But then again, with it being kind of a holiday shortened week, it's possible that some folks are still on vacation and different things like that as well. Now, in terms of any losing positions here today, the one that kind of stands out to me is right here, Meta Platforms, aka Facebook. They were down 4% today. That's a little bit of a head scratcher there, considering the markets were up so aggressively today. Usually a big company like Meta/Facebook would be participating right along on the upside, but they had some company-specific news here today where they had to have some settlements over ad discrimination with the DOJ. So they suffered here today. Disney and Netflix, Warner Bros. And Live Nation, they were all in the red here today, so it seemed like those streaming providers struggled here today. Comcast and Charter, so the cable and internet plays, struggled here a little bit as well. Home Depot and Lowe's were down just a touch, not a whole lot, but obviously part of that greater theme that we've been dealing with for quite some time now, where housing-related investments have really struggled with the fears of mortgage rates going up to 5-6% and what have you, will really start slowing down home buying activity moving forward. Let's go ahead and jump on over to the main part of the platform now and get a sense of market breadth here today. I've got the S&P 500 pulled up on our index watch, and as you can see, there were 440 of the approximate 500 stocks in the S&P 500 closing on the upside here today. So that's good for about 88% of the components closing in the green today. So this was a very powerful day in terms of not just a handful of names carrying the market. It was a broad-based rally. Smaller, medium size, large. It didn't really matter. They were all pretty much going up unless there was some unique circumstances surrounding that. So that's a good sign there, as well as we kind of try to recover from some of these really rough sessions that we've been encountering here in recent days, weeks, and months. 2022 has started off as one of the worst markets in history, either the third or the fourth worst market in history. So this has been really tough going. But we have to remind ourselves that markets don't go straight down either, right? There's always going to be these snapback days. And so we need to be positioned for that, right? Which is part of the reason that when I did the video with you guys on Thursday, I sold the put on the NASDAQ Composite. The NASDAQ Composite snapped back really nicely here today. And so that benefited that put trade there. The put sell, remember when you're selling puts, it's a bullish trade. And so you got to have a few bullish trades even when you're in more bearish conditions to kind of balance the both sides of the ledger there for you. So far so good on that particular trade. Remember on that particular one with the Qs, I was waiting for Friday to have our previous sold put trade roll off the books at max gain, and that did happen for those of you that might not have caught that. So we were able to maximize our gain on that prior sold put trade, and now we have the new one on the Qs going forward until mid-July, and we'll see how that goes for us there. Let's pop on over here to the charts. And wanted to show you this chart 6D here. Remember, anytime we have a big move up or down, I like to show you this chart to give you a sense of how volatile trading has been, or perhaps in some other market environments, the lack of volatility. But most of you are aware by now that we've been living through extremely volatile conditions so far in 2022, and today was no stranger to that extreme movement. S&P 500 was up 2.45% here today. You can see we bounced up nicely off of the intraday yearly lows that were set on Friday's trade here with the candle that you see up above. But in the middle here is where you start gauging how aggressive the movements are up or down. And when we have a big green bar towering higher like we do here today, that references that we had a big positive day. And when we stretch beyond this orange horizontal line, that is a move of at least 2%. So remember, last week we were talking about all the 2% down moves when those red bars were climbing down lower below that orange horizontal line down below, and how we've basically had more 2% down days already this year than in the vast majority of years, entire calendar years throughout history, with just a handful of exceptions there. So notice all those red bars crossing those that orange line down below just in the last 6 months or so. But you have to remind yourself that you also have those snapback rallies that can also be quite aggressive, and today was one of those days, and this was basically kind of in line with the type of move that we had back here on May 27th as well. Now we can see how that ended. May 27th, basically we went sideways, and then we gave way to this massive round of selling immediately after that. So I think we can all look at this chart here and say we're certainly not out of the woods yet, right? We still have a series of lower highs and lower lows, and we just have to know going into it that there's going to be these vicious snapback types of rallies, but it's going to take some time to actually carve out a legitimate bottom. And I think a lot of folks believe we're just not to that point yet. We might be in the short term, but longer term, I don't think there's a whole lot of people out there that believe, oh, that was it. That was the end of, that bearish mode that we had when the markets were down 20% from high to low. I think there's a lot of people that still feel we've got a lot of time to serve yet, so to speak, in this bearish market conditions here. But we have to know that there are tradable rallies along the way, and we might be in the midst of one of those at this moment in time. Also, a heads up, no surprise, but just to put a ribbon on it, VIX was down today, right? Typically, when markets are up, the volatility index goes down, and that was the case today. So we ended at about 30 on the VIX here today, which is still an elevated level, but we still have yet to cross up and beyond 40. We haven't really felt truly capitulative yet. There have been a lot of very interesting market statistics that show us that, these types of, moments are very rare throughout history, and they oftentimes are within the vicinity of a bottom. But, you got to kind of string all that data together to try to determine. And a lot of times you do still need some capitulation there as well. Some of you might have seen my tweet over the weekend regarding the IBD 50. For those of you that are familiar with Investors Business Daily, a newspaper here in the United States, they have a list called the IBD 50 that they put out every weekend. That kind of highlights growth stocks and stocks that have oftentimes a lot of relative strength and what have you. Anyway, point of me bringing this up is over the weekend, I just had noted that the performance of the average stock on the IBD 50 last week was down 12.7%. That's the average stock of 50 stocks, down 12.7% in a single week. There were several stocks that were down over 20% out of that list, and I think there were only 2 stocks out of 50 that were even up on the week. 48 down, and many of them down 20 or 30% in a single week. So on average, they were down 12.7%. And I went back in my notes to see, how far back would we have to go to find another week that looked like that. And it was actually, probably to no one's surprise, the worst week of the coronavirus wipeout in March of 2020. And on that particular week, that index, which of course was different at the time, but whatever that then current 50 stock index of the IBD 50 was down 12.9%. So 12.9% in a week back in March 2020, down 12.7% in a week this past week. And so, yet one more piece of evidence that suggests things are really, really extreme to the downside, which of course we've been pointing out all kinds of things like that for you here recently. So are we due for some sort of a short-term rally? Of course we are. There's been extreme readings all over the place, but I just have that lingering feeling, in the back of my craw, so to speak, that suggests that we're still not done with this pain that the market needs to take here in the next year or two. So just have to brace yourself accordingly. Let's go ahead and come on over here to the 4 grid now. This will be chart 4B for those of you that are following along at home. And as you can see, despite the massive rallies across the board, we did not gain any of our bullish postures back. On all 4 of these major market indices here in the United States, all 4 of them remain with strongly bearish postures despite really aggressive popbacks here today. S&P 500 was up 2.45%. Dow Jones was up 2.15%. NASDAQ Composite was up 2.51%, so that was our leader here today. Again, I'm thankful for that because remember we sold the put on the Qs on Thursday. So the more that the NASDAQ can go up, the better off that particular trade will be between now and the middle of July. So I was happy to see the NASDAQ be the leading index here today. And then we do have the Russell 2000 up 1.7%. So that one kind of lagged a little bit, which is a little bit surprising. They had a spell of time where they were actually kind of leading a bit, but now you can see that they've kind of given way a little bit. And you'll notice that not only were they the underperformer here today, but it's starting to stretch on a little bit further in time. Remember that these different market forecast line colors represent different time periods, with the red line, the momentum line, being the most sensitive, the near-term line being the second most sensitive, and then the intermediate intermediate line being the third most sensitive. And so the intermediate line you can kind of think of as positioning yourself in months, whereas the near-term line is weeks and the momentum line is days. And so when we're looking at that green intermediate line and the reading for the Russell 2000, notice that it's only at 10.13 right now. And if you look at the intermediate readings on all three of the other charts, all of them are now higher than the Russell 2000. And remember, 2 or 3 weeks ago, that wasn't the case. The Russell 2000 actually had the largest number. So it really didn't show that it was ready for prime time to actually be a leading area within the market. So we gave it a chance to try to establish that leadership, but it just refused to kind of really take things anywhere. So all of a sudden, they're kind of on the outs once again. Now, also keep in mind that David is still on vacation right now, so I don't think he was able to do the Market Outlook video over the weekend like he typically does. But just to make sure that we're all on the same page regarding that, be aware that on Friday, we did have an oversold cluster signal on the S&P 500 on a daily candle chart. Remember last week I was working with you guys on understanding that on the weekly candle chart, you had basically your second time in the last decade where a weekly cluster showed up. But even on the daily chart here that we look at on this particular foregrid, you did have that little green dot show up there. I'm going to right click on the chart and go to maximize sell here so you can see that a little bit better. But that occurs when the red, the blue, and the green lines are in the lower reversal zone on the same day. And the hope at that point is that you get some sort of a snapback rally. So today should not have been a huge surprise, knowing that the day after getting a cluster, you're getting a little bit of a push in the opposite direction. I think it also helped that, of course, Friday was options expiration day. And so, some people that might have felt a little bit offsides in their positioning might have been kind of flushed out of the system over the weekend, and now you kind of start with a fresh piece of paper, so to speak. Now, over here on the Dow Jones, you also had a cluster as of Friday, leading to today's reversion to the mean type of a rally. On the NASDAQ Composite, you did not have a cluster on Friday. The blue and the red lines were out of that lower reversal zone. And then let's check the Russell 2000. Yeah, the Russell 2000 you did not either. It was kind of the same situation. In this case, the blue line was in the lower reversal zone, but the red line was out of it. So it was just the Dow and the S&P 500 that ended Friday with a daily cluster in addition to the weekly cluster that I mentioned before. For those of you that don't follow me on Twitter, be aware that I had a request from one of our clients to post the weekly clusters for all the stocks in the S&P 500. And for the reason that David was out of the office, and typically he might send that information out on his Friday email, but since there was no Friday email this week, then I just decided to post that on Twitter. So feel free to go back in my timeline on Twitter if you're curious about what stocks ended with weekly clusters last week. And there were a lot of them. There were like 167, something along those lines, of the S&P 500. The day before on Thursday, I had just checked, and there were actually 200 out of 500 stocks in the S&P 500 with an oversold weekly cluster, which is an extremely high amount, right? That's like 40%. So by Friday, there was a little bit of a bounce, and so a handful of those did emerge without clusters when it was all said and done on Friday afternoon. But still, if there was like 170 or whatever that were, that's still a really large number that you do not see all that regularly throughout history. And again, this was only the second week. Like if I were to go over here and just pull up a 10-year weekly candle chart, and then you can see with the S&P 500 pulled up here, we did formally have a oversold cluster signal on the weekly candle chart on the S&P 500 last week. And in the last decade, there was just that one other instance of it right here in that Christmas time period of 2018, which of course led to a substantial rally immediately afterwards. So could we get one of those types of rallies now? Sure. Are economic conditions different now? Yes, we're dealing with a lot more inflation, higher interest rates, Russia, Ukraine, all that's different right now. But what we do know is that there has been an extreme beatdown that the bulls have taken, and that usually markets don't go straight in one direction. And so you can see there's a massive separation between the 30-week moving average versus where we're trading right now compared to back here. And back here, you ended up having it looks like it was 1, 2, 3, 4, 5, 6, 7, 8. So I think in the next 9 weeks, you had 8 out of the 9 weeks following that cluster with upside price action in the S&P 500. I don't think a lot of people are expecting that this time around. In fact, that was one thing that I had noticed today as well when I had the opportunity to watch a little bit of CNBC here and there between classes and things. Most people that they were interviewing on CNBC would not go on the record of being willing to buy stocks. And that felt like a little bit of a temperature change, right? Earlier this year, I think the traditional mindset was, they'll roll these people out on business television and they'll tell you to buy the dip just like they have for years and years and years, where it worked over and over and over again. But I've noticed that it doesn't really seem like people are aggressively suggesting that anymore. It seems like they're being more tempered now. And it makes me wonder, is this the time when so many people are unwilling to buy stocks right here, right now, that we could actually get a pretty good rip higher? Now, again, my mindset is not that we are going to go and break to new highs. My mindset could be that we could get up pretty substantially from where we're at right now, while not crossing that moving average, and actually have some pretty decent upside potential, there along the way. I think that's a legitimate possibility. So keep your eye on those prospects there. But anyway, just to confirm, we did have our second official oversold weekly cluster on the S&P 500 in the last decade as of Friday. And that meant that a lot of stocks within the S&P 500 also had those oversold weekly clusters as of Friday. And so we had a ripe moment here today for a snapback rally, which I think followed through pretty nicely, up 2.5%. The question is, how much more do we have in the engine? And judging by how far that rubber band has stretched beyond the moving average, there could still be some opportunity to the upside before having to get a little bit more sketchy again to the downside with the bears controlling the price action. The other thing I wanted to mention, hang on just a second, I'm going to go back in there, and I'm going to go back to a 6-month daily. I wanted to point out that there is a little bit of a divergent signal taking place here on the S&P 500 as well, a bullish divergent signal on the near-term line down below. And actually, this is sometimes a little bit easier to see if I'm on a different chart. So hang on just a second. I'm going to come over here to chart 3A. The reason I'm doing that is because on chart 3A, for those of you that are premium members that have access to our charting package, we put a little bit more weight on the blue line down below because this is the chart that we use in my swing trading classes. And so on our other charts, it's the green line that kind of takes center stage, but on this particular chart, it's the blue line. So I want to point that out a bit more because I wanted to point out that when we pull up the S&P 500 like we have right here, we have a bit of a divergent signal taking place. Notice that we have this low on the blue line right here on June 10th. Notice that we also have a follow-up low here as of Friday. So clearly, this Friday low is higher than that low on June 10th. So higher lows on the indicator down below. And then when you look at the price candles associated with those two levels, you're looking at this price candle up above being the June 10th one. And then, of course, here was Friday. So here we had a clear move lower in price, yet we saw a firming up of the indicator down below getting slightly more bullish there. And you kind of combine that with the fact that you also got the oversold cluster signal on Friday, both on the weekly perspective and then also here on the daily perspective. And that's why, maybe there's an opportunity for the markets to try to make their way back up to this moving average again. If we can get to that level, I think a lot of people would, have a little bit of a relief in their portfolio, even if it doesn't ultimately hold and it fails and it rolls over again. At least it gives you that sensation that we're just not plunging day after day after day like we were back here. And again, going back to my comment about cryptocurrencies over the weekend, there was a little feel of capitulative activity in the cryptocurrencies. For those of you that were watching that on Saturday, I was on Twitter, so I got to follow all the tweets in that space, and of course there's a ton of that. But it was louder than normal, right? The temperature was a little hotter than normal, and the back and forth commentary between those that love Bitcoin and those that hate it was a little bit more aggressive, as we saw Bitcoin plunging like $3,000 in just a day, and then snapping back like $1,500 back on the upside, to kind of show you what that might have looked like for those of you that might have missed it. /BTC is a good way to pull that up. It's hard to actually see here because this one apparently was not open, so I apologize. This chart here with the futures might not be adequately tracking it, because I know it got down to like 17,000. I was looking at it on Yahoo Finance. And so if you go to an outside charting package, I'm sure you could see it. Unfortunately, this one is not showing that, but just take my word for it that Bitcoin was down there at like 17,000 bucks. I think it was on Saturday, and then on Sunday it snapped back all the way back above 20,000. And so it almost gave you that impression that there was like some sort of major unwind that was taking place. And by the way, I think this is some sort of a glitch candle, so don't concentrate so much on that. But anyway, that was some pretty wild trading on cryptocurrency over the weekend, and some major round number levels getting tripped up. Makes you wonder, did a lot of people get margin calls? And was that some sort of a significant moment in the young life of the cryptocurrencies? And can that provide some stabilization to the larger growth stock cohort that would be in the NASDAQ composite? So, that was kind of interesting to consider there over the weekend as well. But just to put a bow on it, we have that bullish near-term divergence signal, not just on the S&P 500, but we have that on some of these other indices as well. So maybe that will provide a little bit of feedstock there for a continued rally here for, let's say, the next week or so within the markets. But we are still with those oversold, or not oversold, but strongly bearish levels and postures with that dark pink background color along with the red moving averages, suggesting that price is still below falling moving averages across the board. Let's go ahead and step on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support this presentation. Remember, we do these on a volunteer basis, as we don't make any money from them. They're somewhat promotional for us to get the word out about our business, but hopefully they're also educational to you, which encourages you to participate and check out the videos as time goes on, and hopefully support them. The more that you support them, the more that you're helping yourself get more of the videos. The less that you support them, the greater the chances that there will be fewer videos in the future. So do your best on that. As I always say, as long as we're up and over 100 likes, I'm happy to do a full-length video for you, which is why I'm doing that for you right now. Last time I did the video on Thursday, 118 of you stepped up to click like for me there on Twitter. So thank you to all 118 of you. I'll give you the same offer for the next time I'm scheduled to do this video, which is on Thursday. If you can get 100 likes for me, I'll be happy to do a full-length video, including a trade application example, or if you'd prefer a shorter video that's only, let's say, 15 minutes in length that just covers the 4 major U.S. equity indices, then don't click like. So if we're under 100 likes, then I'll just plan on doing a quick hitter video there, and that way it gives you guys collectively a bit of control over what you would prefer. Do you like the longer form videos with the trade application examples, or do you prefer the quick hitter videos just to kind of get a general overlay of the markets? Also, earlier today, I did teach my dividend growth investing class. In fact, we kind of wrapped up one portfolio here today with a head-to-head matchup in the materials sector. And then next Tuesday, we'll start off a brand new portfolio and look for additional opportunities out there. And that video is now posted. For those of you that are premium members, feel free to come on up here to our trading rooms tab and check out that recording if you so desire. Tomorrow, I'll be back in action with our factor-based swing trading class at 11 a.m. Eastern Time. I'll look forward to seeing many of you there for that. Let's go ahead and talk about our sector selector here as well. Generally, we have a little bit more of a chat about this because we use it for our Monday top-down trend trading class. But with yesterday being the observance of the Juneteenth holiday, where the stock market was closed here, there was no class. So this might be the first time looking at this for a handful of you that would have otherwise seen it yesterday. Be aware that energy did continue to lead from a sector perspective on the sector selector. There was some question about that, right? For a long time, there was no question about it. The energy, of course, was leading. But in the last week or so, we saw energy really get blitzed alongside so many other sectors. And so it did, maybe pop up that question mark as to whether they could continue to retain their stranglehold up at the top. As you can see, this has been number one. Energy has been number one for well over 3 months at this point in a row without even going down to the second place position. I mean, they have just had that in lockdown up there at the top spot. And so they were able to retain that for at least one more week. But some of you might have seen my tweet over the weekend regarding that, and I've got it pulled up here to show you guys as well here on the video in case you don't follow me on Twitter. I wanted to point out that the sector selector rankings have tightened considerably in recent weeks. Energy is still in the lead, but it's no longer a one-horse race. And as you can see from the screenshot that I took, you can see why that is the case. Notice this brown ball and line that kind of goes backwards to give you a sense of what their outperformance looked like over the last, let's call it, month or so. And you can see that it has been intense. It was like energy's way up here and everything else is way down below. Well, after last week's pretty ugly selling in the energy area, you can see that energy took a huge tumble. And while it still has a pretty decent lead over consumer staples at this moment in time, it is no longer one of these massive leads like we saw right here, and consumer staples were down here. Energy is way up here. I mean, that is like in separate zip codes there. Now you're kind of getting closer to being neighbors here all of a sudden. And so we're starting to see those correlations go to one, as I had mentioned in last week's video, where it's starting to get more neck and neck there. And we might very well end up having some rotations into new areas from a sector perspective moving forward. So we'll keep our eye on that. And of course, we'll let you know if we see any major changes taking place along the way. Let's go ahead and pop back on over here to the main part of the platform again. Let's do some 12 grid analysis. Starting with chart 5A, this is our asset class 12 grid. As we're looking at this, you can see that we do have a handful of green or greenish charts out there. A reminder that the background colors, when they're green, suggest that we have a bullish posture using the market forecast technical indicator, and be specific around that. It's the intermediate posture, what I referenced before as the green line. And when you have a dark green background color, like we see down in the lower right-hand corner, that suggests it's a strongly bullish posture. But when you have a light green background color, like we do right here with gold, like we do off to the left here with long-term U.S. Treasuries, and like we do up here at the top with emerging markets, those are what we refer to as weakly bullish postures. Not strongly bullish, but weakly bullish. So it's kind of like, it works in stages. You're not just going to go from being violently bearish to, excitedly bullish overnight. It usually works in stages. You have to have a little bit of a transition period in between, and some of those transitions will just simply fail because they just don't have enough, adrenaline push to get them where they need to go. So we're kind of in that stage right now with EEM, with TLT, and with GLD. We're in that weekly bullish phase where there have been some signs of life here recently, but they still don't look like strong trends. And I think that makes sense as well. If you look at these three light green colored charts, you're not going to be overly impressed with how they look from a trend trading perspective. If we're honest with ourselves, we recognize all three of them have red moving averages telling us that price is below falling moving averages. At the same time, we also have to recognize that in 2 out of the 3 cases, we actually still have our lowest levels a month ago. So like with EEM, notice that we tagged a low back here on May 12th, and we did not breach that low last week when so many other stocks in the United States did that. Remember, the S&P 500 hit a new 52-week low last week. But in the emerging markets, because of the strength in some of those areas like China, we really didn't do any worse than we were back in May. And therefore, there is a little bit of relative strength taking place there on a comparative basis. Down below here with gold, I can make the same claim. We hit a low on gold on May 13th, and we did not quite breach that low here on June 14th. So those two charts look somewhat similar, where you were able to retain that low and it was not breached, and therefore there is a little bit more relative strength taking place right now in both the emerging markets and in gold. Whereas up here with the S&P 500, you can see on Friday we clearly broke down from those lows of where we were trading back in the middle of May or whenever that was. TLT is a little bit different in that you did have a further breakdown from where we were trading back here in May. But I guess because TLT had been up 3 days in a row, that was kind of worth something in that indicator's calculations there, right? Because with the S&P 500, before today, you had 2 days in a row to the downside. But TLT was in the midst of a 3-day win streak there. So I think that kind of helped it in that case, flip back to that weekly bullish posture. But of those 3 weekly bullish postures, to me, the ones that are more interesting are EEM and GLD, because they have yet to breach those May lows, and therefore, who knows, we might eventually look back at a moment like that and say, hey, those were double bottoms, right? That could very well have been a double bottom in EEM last week for all we know, and with gold as well. We won't know, of course, until the future unfolds, but right now we know that the double bottom is holding. We don't know if it will lead to a legitimate reversal, and it could very well just crack down below there later on this week for all we know as well. So we got to be prepared for either one, but just thought I would point that out because that did catch my eye. It's a little different, right? We're so used to all these markets breaking to new lows that sometimes we're not willing to sit up and pay attention to the areas that are just not following suit. And right now, EEM and GLD are giving you a little bit more substance there, a little bit more strength. And so who knows, maybe there's going to be some opportunities emerging from that. In terms of the other charts, you can see that most of them are that dark pink background color, telling us that we have strongly bearish postures on those. That includes the U.S. market, the developed foreign market, so think Europe and Japan and what have you, preferred stocks, foreign bonds, high-yield bonds, Bitcoin. A lot of those are risk-on types of areas, right? I really wouldn't qualify preferred stocks in that group, but I definitely would say Bitcoin and high-yield bonds, even foreign bonds, are a little bit more risk-on, and so still not to the point where those have turned and reverted to the mean too aggressively quite yet. But maybe we'll gather a little bit of steam later this week. But right now, still nothing to get overly excited about with those particular areas of the market. We do have a couple of light pink charts on the bottom rung. We've got the US dollar in the lower left-hand corner, and then we've got oil here off to the right a little bit further. And both of those charts still look reasonably good, right? They do have weekly bearish postures, so we have to be respectful towards that. But the truth of the matter is, if you were just to look at all of these charts side by side by side and take away all the colors, take away, the moving averages and, all the bells and the whistles, and you just simply look at price, you would still look at US dollar and oil as being a couple of the stronger charts on this entire board right now. One thing to be aware of with the US dollar, it's kind of the reverse mindset of what I'd mentioned with gold and with emerging foreign stocks, which, for those of you that follow macroeconomic analysis, this should make sense. But we might be able to get away with saying that the US dollar is in the vicinity of forming a double top, right? If we were going to say that the possibility of a double bottom existed on gold and on foreign emerging stocks, then we could also get away with saying that there is the possibility that the US dollar has a double top. And remember, that makes sense. When the US dollar is strong, commodities and foreign stocks do poorly. And then the vice versa is also somewhat true. And so with the US dollar pulling back here over the last week, at the exact same time gold and emerging markets have been going up slightly, that relationship is kind of holding for the most part at this moment in time. Let's go ahead and now take a look here at our sector 12 grid, and this will be chart 5C. And as you can see, there's nowhere to hide. It is bad news bears out there. Strongly bearish postures across the board. It doesn't matter what sector you're in. There is a good chance that you have suffered pain in your portfolio. And I'm right there with you, so don't think that I've somehow managed to avoid this. I have a lot of long-term investments, and a lot of them have really struggled here in the last couple of weeks. So it's not fun. I don't want to make light of it, but the truth of the matter is it's part of investing, right? And I think most of you acknowledge and recognize that and understand that. If you're going to be a long-term investor, you're going to hold stocks in good periods and bad, and we just happen to be in one of those bad periods right now, and this is the proof in case you didn't believe me. So all the way across the board, ugly, 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 ugly. Not a single one of these charts is showing that the sector is trading above its moving average, let alone rising moving average. So notice that the tips of the 30-day moving averages in all 12 of these charts cases, including energy, which was the holdout for the longest time, all of them are red. And that just means that price is below a falling moving average, and therefore the path of least resistance continues to be to the downside. So could we get some sort of a reversion to the mean rally here in the next week or two? Absolutely. I think that's entirely possible, if not likely, because of how oversold things were there for a while. But just because we get a little bit of a rally does not give you a license to get overly aggressive and thinking that the whole market is going to now turn around and that was it. Hey, we went down our 20%, we took our licks, and now we're off to all-time highs again. Be very cautious around that mindset, because right now the technical analysis is suggesting that's likely not going to occur. And we still have a lot of time to get through these difficulties that we found ourselves in here in this year of 2022. So in terms of better performers here today, I suppose the good news is we did have a clean sweep of bullishness today. All 11 of these sectors were up, even though all 11 of the sectors have strongly bearish postures still, despite being all up here today. Now, in terms of who were some of the bigger movers, let's go ahead and talk about energy. It was up 4% today. Remember when we were looking at that heat map before, I was pointing out Exxon up 6% and Conoco up 6%. So it didn't really matter where you were at. Energy stocks just got blasted so badly in the last 2 weeks. Look at this thing. I mean, it just fell off of a cliff here. And so today was a little bit of, get some of that back type of a mindset, because the pendulum kind of probably swung a little bit too far there. But then after that, you do have consumer discretionary also coming in with a very strong performance today, up 2.62%. That was the second best mover today. And remember, when we were looking at the heat map, Tesla was one of the biggest movers in the S&P 500 today. And remember, Tesla is one of the three most important components within discretionary, along with Amazon and Home Depot. And so no surprise from my perspective there that XLY had such a good day. And we had a good day out of technology as well. Technology looks like it would have been in third place here today, up 2.28% with the strong performance out of NVIDIA and some of those semiconductor companies there. That's actually a good segue into our trade application example for tonight's video. So let's get to it. So technology was the third best performer today. And some of you might have seen when we were looking at the sector selector before that technology is not at the bottom the way that it was a couple of months ago. Technology has actually made itself into kind of the middle rankings. It's not in the upper echelon yet, so we don't want to make too much of it, but there has been a bit of separation between the higher beta areas of technology versus something like consumer discretionary and even communications. Technology has kind of separated itself more positively from those two other areas that is oftentimes very closely aligned with. So maybe that plays a little bit into our trade application example here tonight as well. So the stock I want to talk about is Synopsys, and this is ticker symbol SNPS. And, it happened to kind of stand out today because it was one of the few stocks that's actually trading above its 30-day moving average. Believe it or not, that is actually hard to find in this market. I know that sounds pretty ludicrous, but it's true. If you go through chart after chart after chart, there's not a whole lot of stocks above their 30-day moving averages right now, but this is one of the rare ones, and it's one of them in a sector that's not particularly in favor. Again, with technology kind of being in the middle of the heap, they're not really getting a big boost just simply because they belong to a sector that's in favor. This is kind of a leading stock within a sector that's kind of middle of the road right now. And so it kind of caught my eye because, most technology stocks simply are not trading, above their moving averages. If we were to look, I think you probably saw, I was looking at Apple there a moment ago. Apple is still clearly below their moving average as a technology company. If we look at something like the chip stocks, there's Qualcomm still below its moving average, and Nvidia is as well. And I could rattle off countless amounts of tech stocks that are trading below their moving averages. Yet SNPS is showing us some sort of relative strength here. Now, maybe it's a glitch in the system. Maybe it deserves to be down below its moving average with all the rest of them. But sometimes you've heard the theory that where there's smoke, there's fire. Maybe there is something to it. Maybe there's a product launch, or maybe there's a positive news story that's about to emerge in this company where it's being sniffed out in the market before the news officially hits. And so this stock is stabilizing. And I thought we would do a bullish swing trade on it. Now, this was not an options trade, so it was only a stock trade. And remember, for those of you that are premium members, I did the trade, about 15 minutes before the market closed or whenever it was, and I sent out the trade details to you on the Telegram app. And so, again, if you need to check the execution details or prices or anything like that, refer to the Telegram app. But basically what I did here is I just bought the shares of stock based upon the idea that this one, like the S&P 500, has a bullish near-term divergence signal. So notice down below you have these lows on the blue line. I think the true low would have been that day right there on the 10th. And then you have this higher low that was established on the blue line here on Friday, on June 17th. And the candles associated with those two levels would be this candle right here that I'm circling, and then this candle down here that I'm circling. So price clearly went down at a time when there was a bullish stabilization and benefit on the underlying indicator. Now, in addition to that, you'll notice that the intermediate line is at 52 and rising. So even from an intermediate perspective, we would call this one a strongly bullish posture since it's rising between 50 and 80. And so I just thought it was kind of interesting. Obviously it's a outperforming security as well. The S&P 500's dotted line is down below here, and this company's price candles are up above it, meaning that this company has been outperforming the S&P 500 over the last 3 months of this chart. You'll also see that the moving average, not only is the price above it, as I mentioned before, one of the rare companies in the S&P 500 that's trading above its moving average, but that moving average is actually going higher. That's incredibly rare at this moment in time. There's a handful of stocks that have bounced back sharply here in the last, let's call it 2 days or so, and they might be just barely above their 30-day moving averages, but the moving averages themselves are rolling over. This is a case where not only have we had a bounce back above the moving average in the last couple of days like other companies, but there's been a little bit more bullish stabilization in the last month or so to give you an upward ascent in the 30-day moving average. So I'm just kind of testing the waters there. I'm curious about it. I know it's not a trade for everyone because a lot of people recognize that we are still in the midst of a very bearish market right now with a strongly bearish posture on the S&P 500, but there's always exceptions to the rule, and who knows, maybe this is one that's kind of trying to tell us something between the lines here with some of these bullish features that I just pointed out to you. Okay, so that's what I had for you. You can see that I have my stop loss down below our candle a couple of days ago, and we're shooting for this price target up here, kind of overlaid with a bunch of those prior candles maybe about 2 weeks ago or so. So we're not asking much out of it. We don't need it to break out to new multi-month highs or anything like that. We just need it to get back up into that higher territory where it was at just a couple of weeks back. Okay, so that's what I had for you here tonight. Hope you appreciated the analysis. If you did, I have one simple request for you. Simply click like for me there on Twitter. As long as you do that, I'll plan on doing a full-length video for you the next time I'm scheduled to do it, which is 2 days from right now on Thursday. Remember, David is still on vacation right now, and so his classes and presentations are not being held, but I think he'll be back later on this week, so it'll be interesting to hear from him once again once he's settled back in. But again, if you want a full-length video out of me on Thursday, take the 5 seconds out of your day, click like for me there, and I'll do my best for you on Thursday as well. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.